Hi, my name is Adriana. In this video, my team members and I are going to talk about the concept revolving around the capital structure of a company or firm. However, before we get into all that, the key question to kickstart this presentation: what is capital structure? Well, in a simplified approach, capital structure is the specific mixture between debt and equity that is implemented by a firm to fund or finance its operations and assets. The amount of equity utilized comes in form of common stock, preferred stock, or retained earnings. Meanwhile, debt financing refers to issuing bonds or taking up loans. Despite any proportion of the equity or debt, both are said to raise the capital of a firm. However, firms with a high leverage ratio are referred to as an aggressive capital structure, which can promote higher growth, while on the other hand, higher equity ratio results in a low leverage ratio and a conservative capital structure, which could lead to lower growth rates. So, at what proportion is considered to be the best structure for a company? That brings us to the next part of our presentation.
Hi, my name is AINA SAHIRA and I'll be explaining the optimal capital structure. First of all, what is the optimal capital structure? It demonstrates the best amounts of debt and equity that a company can have in order to reduce its cost of capital and the market value of its securities. So, why does a company need to optimize its capital structure? Having too much debt in a company means the shareholders need to bear the financial risk and the high risk of the required return on equity. What can a company do to have an optimal capital structure? A company should take the initiative by lowering its weighted average cost of capital (WACC). In this approach, the debt to equity ratio is used because it represents the optimal capital structure if it shows the outcome as the lowest possible WACC, which raises the market price while reducing the risk of financial difficulties. Here is how to calculate WACC and debt to equity ratios. So, how do we know when the optimal capital structure occurs? It happens when the proportional debt return equals the proportional debt cost. The best capital structure will find a balance between the additional cost and leverage that may come up during financial difficulties and reduce a company's tax incentive for using debt.
Now, there are factors that affect the capital structure as well as managers' decision. So, the first factor is control over a company. How does control affect the capital structure? Well, by adding investors, a company is further complicating future decision-making as equity shareholders are said to be the real owners of a firm and have the rights to partake in voting for the company's management. So, if a company distributes shares, they risk losing control of their own company. With that being said, how does it affect the decision-making? For a company that does not want to dilute their control, it relies on debts such as loans to fund its operations and assets due to not wanting to add new equity shareholders. This decision will indirectly affect the capital structure as a higher debt ratio is applied compared to its equity. Furthermore, the second factor that influences the capital structure would be the risk of a company in undertaking debt securities and equity securities. Generally speaking, the risk is increased by debt securities while it is decreased by equity securities. Financial risk is the term referring to the risk associated with using leverage concerning the fixed repayment of principal periodically. Therefore, the utilization of debt increases financial risk due to the increased uncertainty in shareholders' returns and the possibility of insolvency. In other words, let's say if debt capital is less used in the mixture, the company can simultaneously lessen the risks. So, this impacts the capital structure in such a way that a finance manager must acquire the optimal capital structure that results in the delight of equity shareholders in efforts to maximize their returns.
Moving on to financial distress, it happens when revenues or income no longer meet or cover the financial obligations of a company because of high costs and a large quantity of illiquid assets. Therefore, prolonged financial distress can potentially lead to a company's bankruptcy. which is not a good sign because it will force them to pay higher interest rates and can cause severe damage to their creditworthiness. This issue arises because of a loss of revenues or income, poor money management, outsourcing expenses, and a worsening economy. When the economy is experiencing a recession, it will cause a decline in revenues. In order to rectify the issue, a company may reorganize its debt or reduce its expenses. The first indication of this is that cash flow when it has insufficient funds causes a company to experience downturns. On top of that, a company must have a good plan in their budget as it is important to make sure their expenses are within their budget. A company with effective budgeting can create a better plan for the development of the company.
Hi, my name is ARISYA and I will explain the integration of tax effects and financial cost distress. According to static trade-off theory, a trade-off exists between the tax benefits of debts and increasing bankruptcy costs. The assumption of tax and bankruptcy costs is relaxed. Based on the static theory of capital structure, we can see three lines which illustrate different cases. First, a straight horizontal line represents Modigliani and Miller Proposition 1 without any taxes because the firm's value is not influenced by leverage. Thus, the value of unlevered firm equals the value of levered firm. However, the capital structure is considered not relevant due to not having taxes. Second, the upward sloping straight line can be defined as Modigliani and Miller Proposition 1 with corporate taxes. It is when the firm's value rises with the leverage, the value of the levered firm equals the unlevered firm's value plus the present value of the interest tax shield. Third, actual firm value is when the value of the firm increase to a maximum value BL and then decrease after one point D, which is the optimal debt amount. In conclusion, the difference between the firm's value in static theory and the firm's value in Modigliani and Miller with corporate taxes is the loss in the value from the financial distress possibility, while the difference between the firm's value in static theory and the firm's value in Modigliani and Miller without taxes is the gain from the leverage net distress cost. Next, we need to go to the root of the agency cost of equity definition, the conflict of interest that occurs between the shareholders and management. If an individual is one of the owners of a corporation, it is clear that he will put in more effort compared to if he is only an employee. When shaking, perquisites, and suboptimal investment decisions arise, there is a cost involved to monitor and prevent management from taking these decisions. Managers may have the motive to take part in the perquisites, but at the same time, they are also in need of opportunity which free cash flow can provide. According to the free cash flow hypothesis, it states that greater dividends should give advantages to the shareholders by lowering the manager's capability to seek uneconomical projects. Also, it disagrees that growing debt will limit the manager's potential to seek profligate decisions more practically compared to increasing dividends.
Hi, my name is SYAHZREEN and I will continue to discuss the pecking order theory. So, what is the pecking order theory? In corporate finance, pecking order theory refers to the theory with respect to the capital structure of the company where the managers follow a specified hierarchy while making a choice of the sources of finance in the company. According to hierarchy, the first preference is the internal financings followed by the external financings where that issue will be considered first to generate funds and success by the equity. If issuing more debt is not practical anymore, internal financings come from retained earnings a company has. So, why do companies prefer internal financing? Because it is easier to raise funds and the initial funding setup costs are almost zero because there are no bankers involved. Moreover, external financings can be divided into two, which are debt issuance and equity issuance. When a company finances an investment opportunities through external financings, a higher return is demanded because creditors and investors possess less information regarding the company as opposed to manager. But when thinking of the pecking order theory, it is useful to consider the seniorities of claim to assets compared to stockholder, debt holder demand a lesser return since there are strong claims to asset in the case of bankruptcy. Therefore, when comparing financing options, return profit are the most affordable, followed by the debt and equity. Moving to the next one is a signaling hypothesis. Signaling hypothesis indicates the action taken by the agent to overcome the problem asymmetric information. This theory assumes the manager knows more about the company more than outside the investor. Dividend signaling is concrete under the signaling hypothesis. This theory determines there is an increase in dividend payment and indicate a strong prospect of the company. In general, signaling hypothesis help the business to find solution and overcome the problem between insider as well as outsiders. It also help the company to show a good performance to the public.
The current situation that we can relate to regarding capital structure issues is how Sapura Energy Berhad, an oil and gas service provider, precariously needs to restructure their debts to save the company. Recently, the firm applied for assistance to the Corporate Debt Restructuring Committee of Malaysia, also known as CDRC, and it has been accepted. This is to intercede its debt restructuring negotiation with multi-currency financiers as their lenders. At the same time, this company is struggling to improve its cash position and decides to sell the Sapura 3000 vessel. Sapura Energy Berhad is facing with extreme financial constraints and liquidity issues for years up till today. With a debt of RM10.3 billion, this company is at the risk of collapse.
To end this presentation, we can conclude that an optimal capital structure plays a major role in the performance of a company. A company must find an optimal capital structure that minimizes the cost of financing and minimizes the risk of bankruptcy, which will help the company to create a better plan for the future. Also, a company must be able to make satisfactory decisions since there are several concerns they need to consider about the capital structure to make sure that the shareholders will get the maximum return on equity.